So we have Derek here to co-host with me today. Thanks everyone for joining us. A few that are jumping in here over the next couple of minutes, but we're going to get started here and we'll let them join. So
Brian, thanks for the intro. Do you want to make me co-host so I can let people in as they come?
I should do that. Thank you for the reminder.
Sure.
Okay, there we go. We'll take the Batman and Robin approach.
And did you
taking some liberties there, considering the circumstances? But there we go.
I have to be Robin. Did you mention that we're going to be recording the use?
This will be recorded like our other workshops. We do encourage discussion and comments and questions as we're working our way through today's content. If you have anything that is private or sensitive or anything like that, of course, please hang on to that toward the end of the conversation here, or bring it offline, and we're more than happy to talk specifics about your scenario or anything that is on your radar if it's not appropriate to be discussed here in front of others that are joining the workshop today. So if you do have comments or questions that you'd like us to touch on as we're working through here, please bring them to our attention. Bring them up in the chat feature within Zoom. Unmute yourself and speak up. However you'd like to bring that to our attention, we would love to have it. So with that being said, Derek, are you ready to get started for today's workshop? It is Thursday, September 16th, and we're going to be talking about insurance rates. Ready to go?
Yeah, let's do it.
All right. Well, like we said, today's workshop has two parts to the agenda. Part one, how are insurance rates determined? Is it a nerdy 17-year-old in glasses somewhere in California locked in a closet punching numbers on his computer? Is it a crystal ball that someone has over in Australia that's setting insurance rates here in the States? How do they actually get determined, and what are the metrics for setting them? Part two, okay, so that's how they're set. Now, what do I do to make sure that I am optimizing my insurance and my insurance rate? None of us want to wildly overpay for anything, especially for our insurance. We want to have a competitive rate. What can we do to make sure we're optimizing the rate on our own insurance plan? So part one, insurance rates. How are they set? Well, first, let's take a quick look here at how do insurance companies make money? At the end of the day, this is a for-profit industry. Everyone is aware of that. The surprising thing is that insurance companies do not make much money on your policy. In fact, oftentimes they make $1 or $2 per $100 of premium. Sometimes they lose money, and it's often intentionally. Insurance companies make money on investment returns. Warren Buffett once said that insurance companies are just poorly run investment companies. They are often turning a profit by investing the premium dollars and the surplus that they've been able to record in the stock market or in bonds or in other vehicles to try to make a profit. So important part to understand here is for every $100 I pay on my insurance premium, very little of that, if any, is actually resulting in a profit to the insurance company. The vast majority of that, roughly 2/3, depending on the year, is going to be used to actually pay claims, maybe to me, maybe to my neighbor, maybe to someone else who has similar coverage. So the point being that claims expense is by far the largest line item on an expense statement for an insurance company.
Well, you're missing the point, though. There's the 50% that goes to the agent as well, right?
Oh, sorry. Yeah, after you account for the insurance agent being wildly overpaid, yes, the next largest expense is going to be the claim payments.
Got it.
Obviously, it's very important for the insurance company to set their rates and to collect premium as accurately as they can. Again, they're not making a huge spread. They're not making a huge profit on the policy, so they need to be as specific and as exact as they can be. What are they using to determine that? Derek, top three things. There are hundreds of factors that go into developing insurance rates, but a lot of them are really splitting hairs, and a lot of them are really out of any of our hands. So what are the top three factors that are going to impact insurance rates?
Yeah, sure, absolutely. Well, the first one is not going to be surprising to anybody. That is claims history. Yes, there are people that have never had a claim in their life. They have that one, freak accident, and then they never have another claim, for the rest of existence. That does happen, yes. But in general, when you file one claim, you are more likely than anybody else to file another claim. So insurance companies see claim continuity as a big factor when they're rating insurance policies. claims are going to drive someone's rates high. The second one is someone's insurance score, and I think we're going to touch on that in further detail later in this presentation, but it's basically a modification of someone's credit score. There's a lot of controversy around whether that's fair or not, but the state of Michigan and most other states in the country allow that, and it's a very, very accurate predictor of the likelihood of someone filing a claim. The higher the insurance score, the lower the premium, and vice versa. The last one is location. Think about how insurance companies operate. They're trying to group their entire book of business into these specific subsets and develop rates for as accurate of a subset of that book of business as possible. If where you live is in a location where there are a lot of people that are having claims for one reason or another, that's going to drive your insurance premiums as well. Interestingly enough, I mentioned from the insurance score standpoint that the state of Michigan approved that. They do have to approve everything that insurance companies use when they are determining the rating for insurance policies. One of the other highly statistical indicator of someone's likelihood of filing claims is the magazines that they subscribe to. This was 10 years ago or so when people were more apt to use magazine subscriptions, but the state of Michigan threw that out. They said that makes no sense, you can't do that, but every insurance company wanted to do it because it was a very good indicator of someone's likelihood of filing claims, believe it or not.
Statistically speaking, yep. State of Michigan couldn't get their head around the statistics to support that, and they said, no, thank you, not going to pass that. But very interesting fact that all of this data is available. Insurance companies pay for it. It's collected by third parties, but they're using as much data as they can to be as accurate in predicting someone's likelihood of having claims. Absolutely.
And it's hard enough to explain, a rate increase due to a claim, especially one that doesn't seem like it was someone's fault. Brian, can you imagine trying to do that when someone changes their magazine subscription? I think we actually can thank the state of Michigan for not allowing that.
I would just pass that request over to you and let you handle that, thankfully.
Yeah, well, handle it, meaning fumble it.
That's right. So claims history, Derek, you gave us a little bit of a teaser. Claims history is a very strong predictor of someone's likelihood of future claims, and therefore a big driver of insurance costs. Are they high? Are they low? Are they somewhere in between? So a couple of things that we're going to touch on here that are driving that. Obvious one, how many claims have been filed in the past? Has this person had a claim all of the last 6 years, every single year, like clockwork? Okay, insurance companies are going to catch the fact that they do not want anything to do with this policy. If they're going to provide that policy, it's going to be astronomical in terms of cost. How much was paid on those claims? Were there a couple of small $800 fender benders, or was there a significant lawsuit that paid $300,000 on it? Were there medical expenses that were paid? Maybe it was a house fire or a burst pipe that had $50,000 paid on it. The larger the claim payment, the more unfavorable that is to be on the record for that person. At the same time, if I've got a $50,000 claim, I don't care what that does to my premium because it's a substantial claim. Of course, I'm going to pay it. Here, we're really going to be talking about the management of those smaller claims that are in the gray area and could go either way.
Right, and I think something important to point out is that in a lot of instances, you're right. Those larger claims look a little bit worse to the insurance company, but in your mind, if you had, one $15,000 claim or three $5,000 claims, which one is going to be rated more harshly from an insurance company standpoint?
The repetitive three claims for smaller amounts are going to be less favorable, certainly.
Probably by a significant margin, right?
Absolutely. Yep. Yeah. Absolutely. Yep. The final two here, what type of claims were filed in the past? And this is an important one. This goes with Derek's comment there, where we're looking at what type of claim was it? And this is where we like to get involved. And this is why we ask our clients to call us to help with filing claims, because we want to be able to help. If it's an $800 fender bender claim, if it was at fault, I hit a guardrail, I backed into my mailbox, I probably don't want to file that claim. But if my car was hit while parked, I was rear-ended, I hit a deer, something of that nature, okay, maybe I will file that claim for $800. So the type of claim makes a big difference in terms of what impact are we going to see by having that claim on the record. Also, is it repetitive? Are there going to be two theft claims in a short period of time? That's tipping the hand to the insurance company saying, hey, maybe I don't lock my door. Maybe I leave my car unlocked. Maybe I just leave my stuff out in the yard for whoever's walking by to take it. those type of things, yeah, they're going to be covered, but they're going to tip the hand that this is probably going to continue happening going forward. So the type of claim is going to have an impact on whether it's worth filing and or what type of impact we'll see going forward. Finally, like Derek said, there are some people who will go 20 years, 30 years, 40 years without a single insurance claim. How long has it been since a claim was filed? The longer it's been, the better we're going to see from an insurance standpoint going forward.
And
to go on top of, yeah.
Sorry, just to butt in, I think what we talk about a lot in the office is that the insurance policy shouldn't be used as a maintenance policy. When you get that call from a client that says, hey, I've got this maybe 150 or 300 or 400 bucks of damage. And yeah, in some instances, we'll file that claim. But in a lot of times, the point is that if you are trying to optimize your insurance rates in the long term, a lot of that stuff is best off paid out of pocket. If you're looking to just get as much money back in your pocket in that one specific year, sure, file those claims. But anybody that's looking out for the long term, you want to avoid using the insurance policy as just a maintenance policy. It really is intended to help out with those financial obligations that you have that you couldn't have otherwise prepared for and might not be able to handle yourself.
Absolutely. Absolutely. And fun fact to go with this slide is that insurance companies do share claims data. So unfortunately, when we go file 2 bad claims with insurance company A, when we go look at moving that coverage to insurance company B, they're going to see those same claims that were filed. The industry shares those across all insurance companies for that exact point. I don't want to pick up this new policy thinking there hasn't been a claim for this person in 15 years, only to find out later that they had been filing a claim every other year. So that data does get shared among insurance companies. They, of course, subscribe to a service that shares that data. Moving on to point 2, Derek, insurance score. You gave us a little bit of a tickler about this earlier. It's based on credit score, or I should say it's using information from a credit report. Then what? And how does this have an impact on someone's insurance?
Yeah, so what the insurance company does is they take, you might have been familiar with what happened during 2020. The state of Michigan said, yeah, you're not allowed to use an actual credit score when you're developing the rate for an insurance policy. But then they winked and they said, but you can use all of the other factors that go into developing that credit score. So in reality, they're using a credit score.
Both parties could go back and shake hands and tell their side that they won that way.
We won.
With the
wink.
wink.
It was a draw. It was really, it should have been deemed a draw. But as each insurance company takes that credit information and then they modify it based on what their own preference is. Some of them are going to look at length of time at a certain residence. Some of them might look at occupation and other different factors that they'll use to tweak that credit score to whatever it is that they think is most indicative of the likelihood of someone filing a claim. So at the end of the day, it's a credit score that each insurance company modifies just a little bit, and each company has a different scale for that. Some people will say, my credit score is 700, but on my insurance policy, it shows that my insurance score is 500. Well, that might be okay because the insurance company might be using a scale from 200 to 600 from an insurance score standpoint, or some of them use A to Z. It doesn't necessarily indicate, point for point where that credit score is, but they're certainly using the credit score to determine where your insurance score will fall on whatever that company's scale is.
Sure.
And
now, how impactful is this, Derek, to my insurance rate? If I have a high score versus I have a low score, am I talking a 20% difference in my rate? Am I talking a 50% difference? I mean, how impactful is this to my actual insurance rate?
50%.
Wow. Okay.
I mean, it's huge. It's tremendous. Whether you've got a 1999 Honda Civic or a 2018 Mercedes S-Class, more impactful than that is someone's insurance score. So it's extremely impactful, and most people aren't aware of that.
Okay. Very interesting. Finally, the third point we want to touch on is location. And location, probably not something I can change very easily. I did buy my home. I'm pretty dialed in and I'm kind of stuck there. But location does have a pretty substantial impact on my insurance. How so?
Yeah, well, the insurance companies, as you know, they have a tremendous amount of data and it is extremely, extremely specific. So They know which side of which street your house is on. They know the way the winds usually come through a neighborhood. They know all of the police reporting activity within each neighborhood, the theft claims, the hit while parked accidents, the DUIs that are reported there. So where you live is going to really impact your insurance rate, not as much as the insurance score would, but it has a pretty large impact there as well. Luckily, here in West Michigan, outside of a few specific areas, most of us have a pretty good benefit of where we live when it comes to the impact on our insurance premiums. If you look over on the east side of the state, you'll see some very drastic differences between certain areas over there, and there are far more areas that really have a detriment to their insurance costs because of simply the location that they are in.
Sure.
So, and another one that's in here, Brian, is how close are you to fire hydrants and a fire station? The insurance company is using something called a protection class to determine how likely your home is to sustain catastrophic fire damage. So what they do is they evaluate every single fire department within the state of Michigan. They find out which one is responsible for responding to your home if you call the fire department. And then they look at that department. How many tankers do they have? How many pumpers do they have? Do they have volunteers, or do they have 24-hour paid employees? What type of training do they have? What's their average response time? And they develop that protection class, and they apply it to all the homes that are within the responding distance of that fire station. So that's a big difference there as well. Here in West Michigan, we're all lucky to have a lot of wonderful fire departments, but you go up north somewhere that's 10, 15, 20 miles from a fire department, and you can bet that that insurance cost is going to be driven pretty heavily by the location of that home.
So I'd much rather have Grand Rapids Fire Department responding to my home in an average response time of 6 minutes than I would, Derek showing up with his bucket responding 3 hours later after he responds to a couple of emails and returns a couple of phone calls. The point being, my home will likely be saved, and it will be just partial fire damage if the Grand Rapids Fire Department can show up quickly, as opposed to waiting for Derek to come and spit on my fire, watching my home just be engulfed in a blaze, right?
Bingo.
Okay, makes sense. Good. So, Derek, we've reviewed three of the biggest drivers of insurance rates. In this illustration here on this page is simply to provide a little bit of a visual representation of what people often like to do. And I'm going to talk to my neighbor and talk about what his home insurance is like, so I can know what mine might be like. Why does that not work very well? Say I've been sleeping through this presentation so far. Give me just a quick summary. Why would my home insurance not look like my neighbor's?
Sure. Yeah, exactly. Well, I think what we've learned here is that a lot of the insurance cost is driven by factors specific to that individual. We talked about claims history. We talked about insurance score. Those are two very big drivers, and those are specific to the owner of the home. They're not specific to the home itself. We haven't talked about the value of a vehicle. We haven't talked about the size of a home or its market value or anything like that. And that's for good reason. Those things, yes, they impact an insurance policy because the coverage amount is dependent on that, but they're not as impactful as people think. So when you have one home versus another one, they might look the same on the outside, but really what you should be looking at is the individual that's owning the home and insuring it and taking their specific characteristics and saying, hey, whether it's this home here or the one a mile away, doesn't really matter too much. The insurance company is mostly concerned with the individual themselves that's owning that home and insuring it.
Interesting. Key point here, developing insurance rates, it's getting more and more complex every year. As there's more data, there's more computing power, there's more claims history. But the goal has been the same since it was hundreds of years ago, which was simply predict future claims as best possible and collect the appropriate premium among all of the coverage that is in place for that insurance company. Derek, part 2. And this is what I showed up for, of course. I don't care how we get there, but how do I make sure I'm optimizing my own insurance rate? So quick look at the top 3 that we just reviewed. Claims history. That's somewhat controllable. We talked about eating some of the small claims to keep them off my record. Insurance score, somewhat controllable. I have, some power over when my bills are paid, managing my credit report. Location, probably not very controllable. I'm probably not going to, rip my family roots out of the ground and move us right downtown Grand Rapids next to the fire station. But nonetheless, we said that that is a pretty strong predictor for insurance rates. So claims history, give us 60 seconds of what we need to keep in mind when considering the claims history and the impact it has on our insurance going forward.
Yeah, well, I think the biggest one, we touched on this earlier, but I think the biggest one is the second bullet point here. Don't file the small claims. When you think about what an insurance company really does, they have a lot of administrative expense and operating costs, which we saw earlier in this presentation. So when you file that $400 claim, yeah, to you, it looks like the insurance company paid $400 and that was it. No big deal, right? But they had to assign an adjuster. They had to correspond with the body shop. They had to issue the claim payment, do all these administrative tasks identically to a $4,000 claim. So when you start to show that you're one of those types of clients that's going to file all of these small claims, the insurance company really doesn't love that, and they start to think, boy, we have a ton of administrative expense, handling and servicing this person. Also, we talked about, how impactful your credit profile and your insurance score is. Well, there are some people out there that, don't have the option to pay a $200, $300, $400, claim out of pocket. And when you refuse to do that, the insurance company now knows. And we said insurance score is incredibly impactful in your insurance rate. Well, now you're giving them additional financial data about yourself that maybe that's not something that you can do, and they're going to hit you with that. So
Sure.
That's what I would say from a claim standpoint. Avoid the small claims. Again, don't use the insurance policy as a maintenance policy. Use it for those things that were unpredictable and that you could not financially afford to handle yourself.
Sure. Yep. Good insight. Insurance score, keep it high. Easier said than done, I know, but having things on auto pay, reviewing your credit reports once a year to see if there's any irregularity or something that needs your attention. Managing credit card debt, of course, is a big thing. And a reminder that most credit reporting agencies do advise that you keep those old credit accounts open. Don't close them down just because you don't use that credit card from Macy's anymore, or you paid this off and you're done with it. Keep that open. The longevity in your credit history is valuable from a credit score standpoint, which should be reflective within the insurance score.
And also something to keep in mind here is we do have clients who were financially successful. They paid off their mortgage. They never needed to use a credit card later in life. And guess what happened? Their credit disappeared because they didn't need it. Well, to an insurance company, you now look like a 16 or a 17-year-old that's never had a credit card before, and they group you in with those from an insurance score standpoint. So even if you don't need to use credit, it is important to at least keep a credit card or two open, put a charge on it every once in a while, just pay it off immediately and make sure that you keep your credit intact, because it can be detrimental from an insurance standpoint for your credit to entirely get eliminated.
Yeah, very interesting. Almost an error in the system. You've become more financially conservative and more financially stable, and yet the credit report dries up and then the insurance score follows suit.
Yep.
Finally, delocation. Not a lot you can do, right? We live where we live. We're not going to let the tail wag the dog here. But if you live out in the middle of the country, a fire detection system, a burglary alarm, water detection system, the kind of things that can help to prevent having some of those claims based on the location of where your home is, will have a larger impact if you live further from a fire department or you're in an area that just simply has higher home insurance costs.
Ryan, we said earlier that the insurance score makes up probably 50% of someone's insurance premiums. Let's say someone did everything under the sun that they could to qualify for every discount on a homeowner's policy: automatic generator, water leak device, monitored burglary alarm, monitored fire alarm, et cetera, et cetera. What percentage reduction in their homeowner's premium do you think they would see?
Well, now you're going to make this slide look irrelevant. 12%, depending on the policy and on the insurance company, but it's minor.
Yep.
It's minor. I mean, so much is driven by those other factors that we've already addressed. It really is.
Yep.
So finally, point 4 here, stay within the insurance company's sweet spot. It's very important that we're aligning coverage and the policy to be in the spot that makes sense. Some insurance companies have a sweet spot for coverage and for deductibles, and we want to ride that. Whether that really fits exactly what you're trying to do or it's basically what you'd want to try to do, there are opportunities there to make sure that things are lined up in the best position for that policy from a value standpoint. Do you want to expand on that at all, Derek?
Yeah, well, I would just say that most of us have a limited insurance budget. If we, didn't, we would buy everything under the sun and just, be very confident in our coverages. But most of us are trying to take an insurance budget and, choose the coverages that are most appropriate for us. Well, if you have, two things that you're concerned about and you're equally concerned about them, but you can't pick both of those coverages because of your insurance budget, well, if one is very expensive with the insurance company and one is a total bargain, you're going to take that one that's a complete bargain, because to you, both of those are equally important and one is much less expensive than the other. So one of these points here, if company A and company B both have a homeowner's policy and the total policy's premium is $1,000, well, when you actually look at the different line items on that policy, the various costs of the coverages, they might be wildly different. So someone that's trying to manage their insurance costs and still feel comfortable with what they have going could look through there and say, wow, that's a huge part of this policy's premium, and I'm not really that concerned about it. Maybe I should take those funds and put them into another coverage that I'm more concerned about or equally concerned about, and keep my budget in check. So it's just something to keep in mind as you're evaluating your policy's coverages and the costs associated with them.
Yeah. So choose what's most appropriate, of course, for you and for your financial position, and then keep in mind where we're going to find the sweet spot with that policy. Yep. So how do I know what a competitive insurance rate is, Derek? Obviously, like you just said, you might look at an exact same premium among different insurance companies, but there's more to consider than that, of course. So give us a little bit of insight here, and then we'll keep moving because we are at our 25-minute mark.
Yeah, I honestly, Brian, this is a shameless plug, but I think that you talk to an independent insurance agent. We work with, thousands of clients. So we see a ton of insurance policies. We see them with, a number of different insurance companies. We know what someone's insurance cost should look like. If someone came up to me and told me what their I don't even need the insurance score. If they just told me that their credit score, their age, location, and driving record, I could tell you within, $100 what their annual insurance premiums would be.
You sound like a chat room from the 90s.
Yeah. But in reality, someone that works in that type of thing day in and day out knows what reasonable insurance premiums are for someone based on their individual characteristics. And that's the best way to get an understanding of, hey, is this really a competitive insurance price for my policies?
Sure. And insurance companies are not intending to compete for everybody under the sun. You may think that based on some of or you may get that feeling based on some of the advertising you see spread all over TV and radio and everything else. But most insurance companies are actually trying to target a specific niche. They're not trying to compete with everyone. So it's very unusual that you'll find multiple insurance companies offering very similar coverage at a very similar premium. That's really not their intent. Sometimes it happens just by chance. But really, they're looking at a more specific subset of the population, trying to target those type of clients that they're really going after, which of course, I guess, secondary shameless plug, but the reason we've chosen to be an independent insurance agency is then we have those different options in the toolbox where you're not cramming the same insurance company and the same policy and the same coverage down everyone's throat and trying to make that work, despite the fact that it may not be the best solution.
Brian, I said that I could predict someone's insurance premium within $100. Do you think that with most people, if they told you that exact same criteria, you could know with 75% accuracy what insurance company is going to look best for them?
Yes. Yeah. But that takes time. It takes a lot of experience and a couple of mid-30-year-old guys, lots of experience. It takes a lot of time, and you have to see a lot of policies to kind of have that. Just to have that knowledge. Yeah. So the point here, like Derek had already said, insurance rates, it's on a relative basis, right? There's a lot that goes on behind the scenes. There's a lot to consider in your insurance plan in terms of coverage and longevity and the quality of that insurance company. But we're of course here and able to help with those decisions and making sure that things are lined up as favorable as they can be. The purpose of what we've provided here is so that you know what happens behind the scenes and what's having an impact. And then there are some things you can do on your side to make sure that you're optimizing your insurance rate and managing that over the long term. With that, Derek, we are 2 minutes overboard, so we apologize for that. But we do appreciate everyone being with us today and participating in this workshop. And I know many of you have participated in some of our others this year. We're very glad to have you. We certainly appreciate your business. We appreciate your time and also your trust. We're going to hang out here for as long as there are any questions or comments because we'd love to chat. We'd love to hear from you. So please feel free to stay on here and unmute yourself or use the chat feature, and we will stay here to hang out. Thanks again for joining us today. We really appreciate it.
Thanks, everybody. Brian, we have one question that came in pretty quickly. Is age a factor for determining auto insurance premiums? The answer to that is yes. In general, it looks kind of like a bell curve. The first 10 years or so of someone's driving experience, they're going to feel the fact that they're a young driver when it comes to their insurance premiums. The tail end of their lifetime, the last 10 years, they're going to feel it as well. But when you're looking at someone between the ages of 25 and 75, that might be a little bit morbid. I know people live, much beyond 85 these days in a lot of instances, but between those ages, most of the time, it's not going to have a tremendous impact. But what the insurance companies are concerned about is that new driver, as well as that older driver that may have had a little bit of a loss in, their driving skills.
Yeah, great. Good question, Dale. Another question here, if someone lives in a rental house, does this have any effect on premiums? It does. I'm going to ask for a little bit of clarification. Well, I'm going to attempt to answer this, and then if I've missed the boat, Nancy, please correct me here. But there are a couple things at play here from a premium standpoint. A couple of them are related to renting a home versus owning. There is a multi-policy discount, and there is generally some credit for owning a home. That's been revised a little bit based on how the law changed in 2020. But in general, owning a home and having a home insurance policy is going to be favorable on the auto insurance premium by the cross kind of collaboration between those two policies. Most people that are renting or live in a rental home will have renter's insurance. There is some impact on the auto insurance and on potential other policies by having a renter's insurance policy in place. But in general, if you're looking for the absolute best bang for your buck, it's going to be having a home insurance policy that is going to be bundled up and packaged with the auto insurance policy. But what we often suggest to renters, a lot of renters are like Derek and I were, 15 years ago, young and dumb and just getting out of school. And so, of course, I had nothing that was worth value. I didn't need a renter's insurance policy. We often encourage those clients to have a renter's insurance policy because, of course, we've seen the value of it. We do see renter's insurance claims, but also the impact on the auto insurance more than offsets the cost of the renter's insurance policy. So, yeah, there is some planning opportunity there, certainly.
Does that even when you live in an apartment or like even a senior housing, that you're in an independent living situation, same thing applies?
For sure. Yep. They look at that from an insurance standpoint. There's really just one deciding factor. Am I living in a home that I own, or am I living in a location that I do not own? And that's the factor there. So is it a homeowner's policy? It's my home, I live in it, or do I live in anything else? It's an apartment, it's assisted living, it's a nursing home, it's my friend's home, it's someone else's basement. Then I'm going to have a renter's insurance policy. So it's really a hard line between those two. Anything on this side where I don't own the place that I'm living, it's going to be in the renter's insurance world.
Okay.
And it's going to qualify for that multi-policy discount that you mentioned, right, Brian?
Yep.
Okay. All right. Thank you.
Yeah, great question, Nancy. Yep.
And Dale had another question. How can you tell whether you're you're getting all the discounts that you qualify for? That's a really good question. And if you think back probably 25 years before Brian and I got into the industry, but the rating was really, really basic. These days we talked about how complex the algorithms are and how much data insurance companies have. But if you go back to before the internet existed, someone would call in, they'd tell you what the value of their vehicle was, what their age was, and you just had this chart and you saw where those two connected and you said, you know, the cost of insuring that vehicle is, you know, $100 a month or whatever it was. Extremely, extremely simple. These days, that's not the case. And the same thing has happened with discounts. Back then, there was a list of, you know, 30 different things, and you went down the list and you checked yes or no for all of these different discounts, and they either got applied to the policy or they didn't. Today, so much of that is automated with regard to an airbag discount or anti-lock brakes discount or crash avoidance technology within a vehicle. That all gets pulled from the VIN number when we input it into the software. Similar things with regard to length of time as a residency. Insurance companies have access to how long someone's been associated with each address. So in general, a lot of that stuff is getting automatically applied to a policy these days. And I think it's safe to assume that most of the time, all of that stuff is going to be incorporated into the premium for that policy. There are a few discounts that are important to know about because the insurance company would not be able to be informed of them automatically. One of those is, you know, the new roof discount. Let's say you put a new roof on your house and, you know, you never tell your insurance agent. Well, the insurance company would never know that. And therefore that discount's not going to be added to that policy. Maybe you installed an automatic generator. Again, not going to be known by the insurance company and therefore should be told to the insurance agent as well. So I think just making sure that you stay in touch with your insurance agent, provide them, you know, with as much information as you can about what you've done with regard to your home and your vehicles and anything else that's happening in your life. And they can make sure that all of that stuff is appropriately accounted for on the insurance policy. But again, the biggest thing that drives insurance premiums is that insurance score. Keep that high and it's going to feel like you've got a discount, you know, everywhere on the policy.
Good question, Dale. What else? There's probably at least one more out there.
Hey, does that include if you're putting new insulation in your house?
Insulation, they're going to say, sorry about that expense that is not very much fun. But it certainly helps keep the pipes from freezing. That is for sure.
Just kidding.
It'll save you your homeowner's deductible when the pipes don't freeze. So consider that a little bit of a discount, I guess.
Yeah, I guess so.
Cool.
All right. Well, Derek, it seems like we've touched on everything then. So we will conclude. Thank you again for the questions and for staying with us for the Q&A. We appreciate you being with us today. And of course, we're happy to help if there's anything that needs follow-up, and our whole team is here to serve. So thank you for being with us and for your feedback, and have a great rest of the week.
Enjoy the rest of the week. Thanks, everybody.
Yeah.